As of 12:10 p.m. ET on Wednesday, January 28, 2026, C3.ai Inc. is trading at 12.93 USD, marking an intraday increase of 0.33 or 2.62%. While this upward nudge might seem like a standard recovery in a volatile tech market, the reality behind today's movement is far more complex than a simple green candle on a chart. Right now, the market is reacting to whispers that could fundamentally change the corporate structure of this company. There are credible reports circulating that C3.ai is in active negotiations to merge with the privately held firm Automation Anywhere. What the average retail trader sees as a potential spark for a long-awaited rally is, upon closer inspection, looking more like a strategic exit or a reverse listing for the larger private entity. If this deal progresses, it might not be the rescue mission many hoped for. Instead, it could involve significant dilution for existing shareholders, as Automation Anywhere was last valued at nearly $6.8 billion, dwarfing the current $1.8 billion market cap of the company we're looking at today. Most investors looking at C3.ai stock right now are clinging to the expectation that the massive surge in enterprise interest for automated intelligence will eventually lift all boats. The narrative has been that as companies move away from simple chatbots and toward deep operational integration, the first mover advantage held by this firm would translate into massive revenue. However, the reality of the last several quarters has been a stark contrast to that optimism. We have seen a steady decline in total revenue, with the most recent figures showing a 20% drop year over year. This creates a massive tension between the AI ticker hype and the actual balance sheet. When you look at the price action today, that 2.62% gain is actually a consolidation after a much larger pre-market pop that saw the stock jump as much as 15%. This suggests that while the initial news of a merger created excitement, the smart money is already questioning the terms. If you are using platforms like Interactive Brokers or checking your positions on the Robinhood app, you've likely noticed that the volatility remains high and the stock is struggling to hold those early double-digit gains. The institutional activity over the last few months reveals a growing divide in sentiment. On one hand, you have heavyweights like BlackRock holding about 7.4% of the shares, providing a baseline of institutional support. On the other hand, the insider activity has been a major red flag for many who follow self-investing strategies. Just a few weeks ago, Chairman Thomas Siebel sold over 300,000 shares at an average price of around $13.52. This represented a more than 30% decrease in his direct ownership. When the person who started the company and has been its most vocal cheerleader begins offloading a significant portion of their stake, it forces a reevaluation of the long-term outlook. It's one thing to see a minor trim for liquidity, but a 30% reduction in the middle of a supposed industry boom tells a different story. If you are managing an individual brokerage account, these are the types of signals that often get lost in the noise of daily price swings. The recent performance of C3.ai stock has also been heavily influenced by the shifting dynamics within the federal sector. In the most recent fiscal second quarter, federal bookings grew by a massive 89% year over year. This is a significant bright spot and serves as the primary defense for those who remain bullish. The government is moving away from custom-built, one-off software solutions and is instead mandating the use of commercial off-the-shelf technology. This shift plays directly into the strengths of the C3 agentic AI platform. But here's the catch. Despite this massive growth in government contracts, the company still reported a net loss of over $100 million for the quarter. The gross margins, which used to hover around 70%, have compressed to roughly 54%. This is the core of the expectation versus reality problem. The expectation is more contracts equals more profit. The reality is that the cost of deploying these initial production environments is eating up the cash faster than the subscriptions can replace it. When we talk about online investment and the tools available today, many people look toward solutions like Schwab Intelligent Portfolios or SoFi Invest to manage their risk. But with a high beta stock like this one, those automated systems often struggle to keep up with the rapid changes in the underlying business model. C3.ai has been transitioning its sales approach, moving towards a consumption-based model and working more closely with partners like Google Cloud and Microsoft. In fact, their alliance with Microsoft has led to over 100 joint customer agreements, yet the stock remains down nearly 60% from its 52-week high. This suggests that the market is no longer willing to pay a premium for potential alone. Investors are now demanding a clear path to positive cash flow, something the company has yet to provide. If you are using investing sites for a quick win, the current volatility around the merger rumors might be tempting, but the technical indicators remain bearish. The stock is still trading below its 200-day moving average, and the recent sell signals from the MACD suggest that the downward trend has not yet been fully broken. Take a second and let me know your thoughts on this specific sector. Comment below how many shares of C3.ai you currently hold, or if you are waiting for the merger details to be finalized before making a move. To understand where this goes next, we have to look at the business model itself. C3.ai isn't just selling a piece of software, they're selling a platform that allows other companies to build their own internal applications. Their strategic integrator program is a key part of this, essentially licensing their platform to other developers who then build industry-specific tools. This is a smart way to scale without having to hire thousands of engineers, but it also places a lot of reliance on the success of those partners. If the partners don't see value, the entire ecosystem stalls. This is very different from the way we see NVIDIA stock or Apple stock behaving, where the demand for the hardware or the ecosystem is almost guaranteed by the consumer base. Here, every sale is a hard-fought battle in a crowded enterprise market. There is also the matter of the competition. While Palantir has seen its valuation soar by over 100% in the last year, C3.ai has lagged behind significantly. This performance gap is a major point of frustration for those who use Fidelity Investments or the SoFi trading platform to track their tech holdings. The reality is that the market is currently picking winners, and Palantir's ability to show consistent profitability has made it the darling of the sector, while C3.ai is still viewed as a speculative play. The potential merger with Automation Anywhere could be an attempt to fix this valuation gap by combining with a company that has a more established footprint in robotic process automation. However, merging a predictive modeling firm with a legacy automation company is a massive integration risk. These are two very different types of technology, and trying to mash them together could lead to years of operational headaches. For those engaging in online investing through a Fidelity brokerage or a Robinhood investments account, the technical levels to watch are quite clear. There is a strong support level around the 12.50 mark, which has been tested several times. If the stock breaks below that, the next major floor is down near the $8 level, which would be a catastrophic drop. On the upside, there is significant resistance at $14.02 and again at $16. Until the stock can clear those hurdles on high volume, any rally is likely to be met with selling pressure from those looking to exit their positions. We are seeing a lot of trap behavior lately, where a stock pops on news only to give back those gains within 48 hours. Today's 2.62% gain is positive, but it hasn't yet broken the pattern of lower highs that have defined the stock for the past 6 months. The macroeconomic environment is also playing a role here. With interest rates remaining a point of contention for growth stocks, companies that are losing $400 million a year on an EBITDA basis are being punished. It doesn't matter how great the technology is if the company has to keep diluting shareholders to keep the lights on. While they do have about $675 million in cash and short-term investments, that runway isn't infinite. At the current burn rate, they have a few years of survival guaranteed, but that doesn't necessarily mean the stock price will go up. This is why many people are looking toward Fidelity Wealth Management or specialized investment help to diversify away from these high-risk individual stocks. When we look at the future outlook, there are two main scenarios. The first is that the merger with Automation Anywhere actually goes through, and the combined entity becomes a powerhouse in the enterprise space, leveraging the public ticker to raise more capital and eventually reaching profitability. In this scenario, the current price of $12.93 might look like a steal. The second scenario, and the one that the current price action seems to be leaning towards, is that the merger talks fail or the terms are so dilutive that the stock continues its slide. Given that the CEO of Automation Anywhere would likely want to maintain control, the current C3.ai shareholders could end up with a very small piece of a much larger but still unprofitable pie. When you are using Fidelity mobile app or checking your Interactive Brokers account today, the key is to look past the AI label. The expectation was that this company would be